Good afternoon, everybody, and thank you for joining today's webinar. My name's Alex Seller, and I'm an associate partner with the Heritage Partnership, a partner practice of St. James's Place, and I'll be your host today, as well as one of the three speakers for today's webinar. So securing your family's financial future is the theme of today's session. Over the next hour, we will discuss the fundamentals of estate planning, protection planning, as well as education fee planning, along with practical examples, which we hope can help in your journey to achieve a financially secure future fit for you and your family. So joining me today, we have two speakers and experts in their relevant fields. We have Jasmine E. And Matthew Pinkard. Perhaps I could open up the floor to them to just introduce themselves and I guess give a short introduction in terms of the work you do. So over to Jasmine, perhaps first of all.
All right, thanks, Alex. So good afternoon, everyone. I'm Jasmine, and I'm a tax and technical consultant with St. James's Place in Singapore. And my role is basically to provide specialized support to the St. James's Place partners, such as Alex himself, focusing on taxation and trust issues in relation to the client expenses. So yeah, that's kind of a nutshell of what I do.
Perfect. Thanks, Jasmine. And Matthew, perhaps just a short intro.
Sure. Good afternoon, everyone. My name is Matt Pinkard. I am the Senior Manager for Intermediate Distribution with Aviva. I primarily focus on the expat market within Singapore. My role is to essentially support expat advisors in Singapore with training on Aviva's products and then support through from the new business stage through to policy issuance. I've been in Singapore now for 8 years and I've got around 16 years of industry experience.
Perfect, thank you. And now just a brief overview of today's webinar. So we've actually segmented the webinar into 3 sections. So as mentioned, Jasmine will take over and discuss the premise of a robust estate planning. Matthew will cover off the fundamentals of protection planning, and then I'll take over the last segment where I'll share some insights into planning and investing for your child's education. And I'll split this from the international school fees all the way through to the university. We'd like to keep this session interactive, so at any point if you have any questions, please type them into the questions box, which you'll find in your control panel. I believe it's on the right-hand side of your screen. And throughout the Q&As or within the webinar, we can address those questions between the segments. So before moving on, I think we'll open up with an opening poll. So we'll just like to get the thoughts of the audience to begin with. So which of the following aspects of your family financial planning are you most confident about or you already have in place? And of course we have the options of estate planning, protection planning, as well as the education fee planning for your children. So we'll have a few seconds on there. Perfect. Brilliant. So without further ado, I will hand over the reins to Jasmine, who will introduce the estate planning and key considerations with regards to this. So over to you, Jasmine.
All right, thank you, Alex. So I guess we'll just open with a question. What legacy will you leave behind? So I'm sure this has crossed your minds probably a few times. You know, you might have a plan and you might not. A legacy plan should be a key part of your financial and estate planning. And this ensures that you can better secure and pass your assets and wealth to your family and loved ones in the event that something happens. So whether you would like to help your children onto the property ladder, contribute to your grandchild's education or wedding, these are all things that we can definitely help with as well. So on to the next slide. So The St. James Place in Asia, we have commissioned a survey on retirement and wealth planning last year. And as you can see from the slide, only 38% of the people polled in Singapore have a will in place, which means that over half of the respondents under the age of 40 did not have a will. I think this highlights the challenges and the inadequacy of retirement planning, especially among younger people, and also does highlight the importance of planning early. As we'll come to the next few slides, we'll definitely kind of talk about how we can help you with estate planning and just putting in place kind of structures that ensure that your assets are kind of protected and left to your children. So there are some of the estate planning instruments that individuals use to structure their wealth, and these are, the use of wills, lasting power of attorneys, and trusts are quite common. And then these also involve putting in place measures that help safeguard your interest and ensure that your assets pass down to the correct individuals in a timely manner. In recent years, there has also been a push towards utilizing family offices and companies to help high net worth individuals structure their wealth. But of course, it involves quite a lot of complexity. So it may not be as easy and straightforward as utilizing wills, lasting power of attorneys, and also trust as well. So many people don't actually think about guardianship when it comes to estate planning, but actually it is one of the most important things to consider if you do have minor children. And consideration should be given as to whom you would want to look after your children if something happens to you. Before appointing someone as a guardian, it is a good idea to talk to them first and to make sure that they are comfortable with taking on the responsibility of caring for your children. One of the things we would encourage you to consider when you're considering appointing a guardian is to just check if they have any kind of relationship with children in general, whether they have children as well, and whether they will be able to handle the responsibility of looking after your children in addition to their children as well. So being a guardian is a huge responsibility, and the decision of who to appoint should definitely not be taken lightly. And if you are unsure as to whom to appoint as a guardian, our selected legal services providers will be happy to discuss this with you and also offer you guidance. And yeah, if you want more information, then do get in touch with us as well. So perhaps let's look at wills and also why it's important. A will allows you to pass on your wealth to your family members in an effective and efficient manner in the event of something unfortunate happening, such as an accident or even death. So upon your death, the executor of the will be responsible for administering your estate and also distributing your assets to your beneficiaries. And a will is especially important as well if you want to avoid your assets being passed down to someone that you have not chosen, which we will be discussing in the next slide as well. So what happens if there is no will? So intestacy is what happens if you have no will in place. By not having a will, the distribution of your assets will depend on a number of factors, such at the time of your death, such as whether you have a surviving spouse or whether you have children rather than your wishes. So this means that your assets could pass to individuals you may not have chosen, whilst ignoring those closest to you. So it is certainly advantageous for you to start the process of succession planning early, as many people usually leave it too late and rarely consider the need to structure their wealth. And that goes back to the survey that we showed in the beginning of my presentation, where only 38% of the people polled had wills in place. So that leaves a large proportion of the people, without any kind of planning for a will. Okay, so now that you have a will, what happens, right? Upon your death, a grant of probate is a valid legal document that is needed to deal with your assets and liabilities within your estate. And this is something that your executor will apply to the courts for. And when granted, it basically gives him or her the authority to deal with your estate. And once probate has been obtained, this is when assets can be distributed out of your estate and thereafter to your beneficiaries as well. If there is no will, then your close relatives or personal representative will have to apply for a grant of collective administration. They then become an administrator of your estate and have the same responsibility as an executor. And also, if you do hold assets in other countries, such as in England, for example, if you have properties in the UK that you rent out, then a grant of probate that is given in Singapore, for example, can be received in the English courts so that your personal representatives can administer your estate in England. So let's go on to trust and basically discuss how trust can benefit you. Setting up a trust can be a good way to hold assets for the benefit of someone while retaining control over those assets. So essentially, it's something that you would consider if you don't actually want to let go of your assets and your entire estate, but would like to set it aside for your beneficiaries to have at some point in the future. Setting up a trust also avoids any unnecessary delays that are associated with obtaining probate, since it's not required in that case. And also, if you would like to pass on assets to your children, for example, if you want to help them onto the property ladder, or even for education planning, a trust is very useful, given that it allows for flexibility to determine how much you want to give to your children, whilst also enabling you to give at the right time, possibly, when your kids are a bit older and more responsible with finances as well. So with that, it brings to an end to my presentation. If you do have any questions, just shout, and we'll address them.
Perfect. Thank you very much, Jasmine. Very, very insightful. So just a couple of questions that have come in so far from the audience. So first question, I have a will in place already to allocate my assets. Why would a trust be necessary as well in this instance?
Yeah. So yeah, I mean, it's a good question. Trust is actually quite different from will. So that is the main thing to take note of. Trust takes effect as soon as you create it, and it can be used to manage or distribute assets at any time before or after. A will, on the other hand, can only take effect after your death. So with trust, the legal ownership of the assets lies with the trustees, but you are also allowed to be a trustee on your own trust if you want to do so. It is also fairly common for people to set up a trust with third-party trustees, such as a professional trust company, for the purpose of protecting their assets from lawsuits, bankruptcy, divorce, so on and so forth. And another benefit is that there is no need for probate, which on one hand is necessary when a will is involved. So yeah, I mean, a will, however, does allow for other instructions, such as care, upbringing of your children, such as who will be in, etc. Whereas the trust is only really used for distribution of the asset to your beneficiary. So yeah, I mean, I would say that trust and will are actually quite different, and they fulfill different kind of requirements. And I would say that a trust therefore kind of complements a will rather than being one or other kind of thing.
Sure. Okay, brilliant. And then another question in terms of the allocation of assets. So somebody's mentioned it can be quite a sensitive topic, especially amongst the family. But what's the best way, and how do you recommend this is to be carried out?
Yeah, another good question. So yeah, I mean, I fully appreciate that money is an awkward thing to discuss with family, and just anyone, like, I mean, even your spouse, I would say it's quite an awkward thing to discuss. And oftentimes, I guess parents would not want their children to know their wealth and also how much they're getting from their estate. So I would say that a sensible thing to do is to speak to an expert about your asset and how you wish to distribute them, which is, of course, something that we here at St. James's Place can help with. So we can guide you through the various options available and assist you with making recommendations from an objective standpoint. Yeah, if you do need any help, then do get in touch with us.
Great, brilliant. I think that concludes the first section. So thank you, Jasmine, for all that useful insights. So now we'll move over to Matthew Pinkard's section. So he'll be discussing the importance and need for protection planning. So over to you, Matthew. I'll exit the webcam.
Okay, great. Thanks, Alex. So when it comes to protection planning, there's several different reasons, several different motivations for people taking out protection. In terms of straight protection, you may be looking at inheritance tax planning, partly that links into what Jasmine's just been discussing, or you could be looking at protecting spouses' financial future, children's education, things like that, in the event that you're no longer around to provide for your family. So the things that I'd like to talk about today. So I'll start off talking just a little bit about cancer and really the facts around cancer. Now, these stats are from 2018, but we found it very difficult, and I'm assuming to do with the current coronavirus pandemic going around, to actually get hold of more updated stats. But these are still generally quite relevant. So cancer figures amongst the leading cause of death worldwide. It accounts for 9.6 million deaths in 2018. The 5 big ones are lung, colorectal, stomach, liver, and breast cancer, and they cause the most deaths. 1/3 are due to the 5 leading behavioural and dietary risks. So obviously having a high BMI, low fruit and veg intake, a lack of exercise, smoking accounts for 20% of global cancer-related deaths. And alcohol is the next big one. So these are all things that we all do generally. Some of us on this call may look at that and think, yeah, I like to have a drink. Some of us may smoke. We probably don't exercise as much as we'd like to. When we say a high BMI, usually anything kind of 25, 26 is considered to put you in the obese category. So that's very important that people understand and know their own BMI. Okay, we can move there. Okay, so alcohol. So what does it mean in terms of alcohol? When Aviva are reviewing an application, it's industry-wide, it's deemed that if you have more than 14 standard alcoholic drinks a week, it's considered to put you at higher risk. So as long as you generally stay within that 14, the medical community would look at that as being reasonable. What essentially is one standard drink? It's a half pint of beer, it's a small glass of red wine, or it's a pub measure of a spirit. So looking at that, I mean, do any of us stick within that? That's essentially, if half a pint of beer is one standard drink, that's 7 pints of beer a week. If we have more than that, we're considered to be taking far too much alcohol on board. And the potential costs of cancer. Obviously, for those of us that anybody on the call that comes from the UK, you would know that we have the national health system, but it's not as easy as getting something and getting yourself in for treatment the next day. You're on waiting lists, whereas Obviously in Singapore, the medical system is such that if something's picked up, you could essentially be in having treatment within the next couple of days. But that comes with a high cost associated. So a biopsy in a private hospital in Singapore, you're looking at around $6,275. Surgery is in excess of 18,000 in a private hospital. Chemo can cost 1,500 per cycle. Radiation therapy, anywhere between 25 to 30,000. Immunotherapy is 9,000 per dose and can cost between 156 and 234,000 per year. Estimates actually suggest in Singapore it would cost around 100,000 per year to recover from cancer, and that's usually assuming that that it's been picked up at such a time that it is quite treatable. So why take a critical illness plan? Obviously, taking a critical illness plan for additional coverage for medical emergencies. Obviously, you know, if you fall over and break your ankle, that's not what a critical illness plan is meant for. It's meant for critical illnesses in terms of heart attack, cancer, things like a stroke, that type of thing. So these are things that would come with higher than average medical costs associated with them. Cash payout, in terms of Aviva, when you take out critical illness cover, the amount is paid out to you in cash. So it's not a case of you going to the doctors, having treatment, having to pay this, having to claim it back. As soon as you get a registered a report from a registered medical practitioner to confirm that you meet the definition, then Aviva will pay out in full. And that's where it helps with loss of income also, because obviously at such a time that somebody is trying to recover from a critical illness, they may have the stress of needing to go back to the office. If somebody's role is very much dependent on, let's say, a commission basis or very high bonus payouts for certain KPIs being met, then there's obviously a loss of income that comes with that. And one of the most common reasons for relapses from critical illness is people rushing back to work too fast. And ultimately, when it comes to critical illness, life still goes on. As sad as it seems, if it's happened to yourself, if it's happened to a loved one around you, it's very difficult to understand that everybody else is going about their normal every day. Your creditors, your landlord still wants their rent being paid. You still have other household bills you still need to pay for, you know, maybe your car, your petrol, your car insurance, your daily food bills, anything else. So life is still going on around us. And do we want to be taking that money from our savings that we're saving? And I know I should take cover, but I'm still young and there's plenty of time. I think a lot of people are under the misconception that they can wait to take cover. Why would I be paying for something now when it's not likely to affect me for the next 10, 15, 20 years? I'll take it further down the line. This is a very common misconception when it comes to insurance. Every year older you get, insurance gets more expensive, and that's the life cover element and the critical illness element. So as an example, if you are a 30-year-old, you can take 35 years worth of cover up to a standard retirement age of 65 to protect yourself against early death or to protect yourself against critical illness. And for having 35 years worth of cover, that will cost you less than a 35-year-old taking a 30-year plan on the same levels, or a 40-year-old taking a 25-year plan. So why would you wait to take cover? In the event that something does happen, in the event that you are unfortunate enough to get a critical illness, the insurer will look at that and potentially load or exclude your policy because it's a pre-existing condition. Similarly, you may be affected by family history. So if, for instance, if a lady's mother has had breast cancer before the age of 55, you are considered to be at higher risk, in which case you are likely to be loaded or excluded on that basis for cancer. So obviously waiting is false economy, and you're running the risk of paying a much higher premium or not being covered for certain important things as time goes on. And looking just a very quick example, we have a policy called multi-pay, which is a multi-paying critical illness policy. It covers from early, intermediate, late stage and reoccurrence critical illness cover. So as an example, 75% of Aviva's claims in Singapore are cancer related. So if a 30-year-old female takes out the policy up to age 65, they pay 15% less than a 35-year-old, 28% less than a 40-year-old. That's over the total term of the policy. And similarly with a man, 23% less over the policy term than a 35-year-old, or 41% less than a 40-year-old. So taking out that cover and making sure that you're covered for the early, intermediate, late stage and reoccurrence of any critical illness, particularly cancer, is very important. And what do we typically insure? I think people typically, if you own a car, you insure your car. People will insure household items like a TV. If you are going on holiday, as in the picture, you're going on a skiing holiday, most people wouldn't go and do a skiing holiday without having insurance, because your first thought is, I break my leg on the mountain and have to be rescued. It's going to cost me a fortune. Also, mobile phones, people take out cover for mobile phones, and expensive watches. People will buy a watch and they will take out cover for that. What people don't consider is your actual worth. So let's say you're a 35-year-old that has 30 years worth of working, and let's say you're earning 100,000 a year. Over that 30 years, your worth to the family is far higher than the cost of being rescued from a mountain, or the cost of an accident in your car. It's just there's certain things we wouldn't even consider not insuring, and quite often people don't actually consider the most valuable thing in their world is themselves, is their own health. And finally, what is your worth? Essentially, as in the image, a tall Starbucks latte costs you around $4. That is essentially what insurance would cost you for life and critical illness, $4 a day, depending on the age that you take it out. As I say, that will only get more expensive over time. You leave it a year, that may be a grande latte, and so on and so on. So it will get more expensive as time goes on, so don't wait. Okay, and that brings me to the end of my presentation. I hope you found that interesting. I'm happy to take any questions.
Perfect. Thank you very much, Matt. It's very, very insightful. And quite some startling stats there. So don't want to put a downer on too many people in the audience. Just addressing a couple of questions that have come in from the audience. So firstly, a very topical one with regards to COVID. So what is Aviva's stance, or even your perspective on coverage payouts related to COVID?
Okay, yeah, a very important question now, and essentially impacts all of us around the world. In terms of COVID is not considered to be a critical illness. So insurers across Singapore follow the LIA definitions, the Life Insurance Association definitions of critical illnesses, of which there are 37 critical illnesses at this point in time, and the 66 early stage conditions that Aviva will also cover. But just looking at the LIA conditions, COVID isn't one of those. Now, obviously in the future, if the LIA were to add COVID as a critical illness, we would likely cover that as well. But at this point in time, if you were to get COVID, you couldn't claim on the critical illness portion because it's a recoverable disease. But if somebody were to get COVID and die from that, then we would pay out on the life element. Similarly, if somebody were to get COVID and then as a result of that, they ended up having, let's say, lung cancer, because that's a respiratory disease. Somebody has COVID, then gets lung cancer. Again, we would pay out based on the diagnosis of lung cancer, as long as it meets the definitions. So I think it's also key to point out that none of us know the long-term impact of COVID as it stands today, and that will probably take a number of years to come out. So if we look at some examples, I mean, recently some people may have seen in the press, there was a scan of somebody's lungs that had COVID, and it actually showed that that person's lungs were worse than a 30-a-day smoker, and that person was not a smoker. Incidents that happen around the world, I mean, 9/11 is a good example, where a lot of the firemen that went into the building at 9/11 and now have cancer as a result of the asbestos poisoning from the building. So somebody having COVID, do we know that in 5 years' time, is there going to be a stat to say, you know, a third of people that had COVID went on to get lung cancer as a result of that? It's possible. If that happens, insurance companies will likely take a course of action where where they look at saying, well, if they're looking at insuring myself and yourself, Alex, and I've had COVID and you haven't had COVID, the insurance company are unlikely to say they would cover us both based on the same price. They're likely to say to me, you're at a much higher risk, so you can either pay a higher premium, or there's likely going to be an exclusion on to say we will not pay out because you're at a far higher risk. So I think it's key while this is happening for people to look at getting their cover in place now, lock it away in a drawer, carry on with the rest of your life.
Got you. Thanks for that. Another question, so relating to family history. So can I get coverage if I have a family history of heart disease, diabetes, or cancer? I think you covered it briefly, but maybe just reiterate it again.
Sure. So in terms of family history, yes, we will take into account family history for close family. So for mother, father, brother, sister, all insurers would factor that in. And if it's something considered to be hereditary, you may be looking at loadings or exclusions on that basis. In terms of diabetes, is a tricky one, because if somebody's got stage 1 diabetes, then it's likely that they may not be covered, or we may only offer life cover with a very heavy loading because it's a pre-existing condition, and diabetes is something that will never get better. At this point in time, there's nothing medically that will reverse the effects of diabetes. Therefore, it's only something that will remain either stable or get worse over time. So yes, I've had policies in where we've covered for diabetes, and certainly if somebody has diabetes, definitely if you can get cover now, get cover now.
And then building on from that, another one about the typical age until life insurance is taken. Is it 65, or any other recommendations that you would say for this?
Yeah, I think really it comes down to, obviously the standard retirement age would have been 65, and at that point you would consider somebody to have ticked all the boxes in terms of finances. In terms of if you retire at 65, you no longer have to protect that family for you not being around to provide for them, because at that point in time you should have everything in place already. There's an argument you could carry on with the critical illness cover beyond that. That's obviously down to the client. But what I would say is look at that in terms of the country you intend to retire in. So for me, being from the UK, ultimately I'm most likely to retire in the UK. And by the time I retire, the retirement age will be age 68. So I would be looking to take cover up to age 68 to protect me up to retirement. And that is something that I can always cancel early. So the thing with life insurance, you're paying your premium, whether that be monthly, quarterly, half yearly or annually. If you decide at any point that you no longer require that cover, you can always just stop paying the premiums or just cancel the policy. Or you can reduce the cover down. So if, for instance, you had a few great years at work where you earned good bonus and you built your wealth that way, and suddenly you looked at it and thought, okay, I don't need 3 million of life cover anymore, I probably only need 1.5 million, you can reduce that cover down, no problem.
Brilliant. Thanks for that, Matt. So we have a couple more questions, but perhaps we can revert to those towards the end in the open Q&A section. So thank you, Matt. We'll now move on. So this is the final section of today's webinar. So no grand introduction for this part, as I'll be doing the speaking. So very much a self-introduction. In this section, we'll be talking about education fee planning, and I've really structured this into, firstly looking at some key trends, but then segmenting between international schooling and then university education, and then I'll conclude with some examples of the true costs of sending your child through the education system. So once again, let's open up with a poll. Are you aware of the true costs associated with your child's education? We have a few answers here. So yes, and your planning is already in place. Yes, but you haven't started planning. No idea, and you're saving towards it. And no idea, and there's no plan in place to date. So if we could just have a few seconds on this. Brilliant. Thank you very much. So let's move on to the next slide. Great. So just to kick things off, I thought I'd share some facts and figures based on a global survey. So on average, a student actually faces a funding gap of $25,000, and 83% of students are actually juggling both work and study. So of course, the focus is actually taken away from educating, networking, and participating in those extracurricular activities. To mitigate this, 77% of parents interviewed actually plan to take care of their child's living costs through their university years. 60% of university students see value in their education, preparing themselves for their long-term future. And that obviously supports the idea that parents are placing it as a priority from an investment perspective. And actually 84% of parents are funding their child's education from day-to-day income. So this, of course, has a knock-on effect whereby they'll have to stop or even reduce their leisure activities as a penalty for not having planned ahead. So I guess all of these points here just really give some sort of high-level overview in terms of the importance of planning and starting early, obviously to make the journey achievable and easier over the long term. So moving on to the next slide. So this section, as I mentioned, we're going to split this into international schooling, and then I'll cover off university. So to start with, looking at the international schooling across the globe, historically the trends have been very much going upwards in terms of the fees rising year on year. Here we actually have a breakdown of the average price per year across the globe. It's worth noting that these prices are in US dollars and not in Singapore dollars. Later on, we'll have some Singapore dollars stated statistics. So 16 out of the top 30 most expensive cities globally are actually located in Asia, with China obviously being the standout in the pack, with a number of their cities featuring in the top 10. Singapore actually comes in at 12th on the global table, and then Hong Kong follows in at 18th most expensive globally. Moving on to the next slide, we actually hone in a bit more onto Asia, so I won't dwell on this too much. It's very much the same statistics, but I think one key message here is it's quite startling figures. So these prices are, of course, annual fees, as the title suggests, per year, and it's likely you'll have to fund this from primary and secondary schooling for your child. So it can be some quite startling figures over the long term. So we'll have a look at the international schooling on a global stage. Now we'll zoom into a bit more of Singapore. So here you'll find a spread of the annual international school fees across Singapore. As you can see, it ranges from around 50,000 per year all the way through to 18,000 on the lower end of the scale. These figures here are actually now based in Singapore dollars. So earlier it was US dollars, now Singapore dollars. And these fees actually include the application fees, annual tuition fees, as well as the admission and building and facility fees. As you can see here, so some of the more common names, the likes of Tanglin, UWC, and Dulwich, that they all sit on the upper end of the spectrum, amounting to around $40,000 or above per year. But it's also important to note the additional costs. So as mentioned, I gave the summary of what that breakdown earlier covered. There's also, on top of your annual fees, a number of other costs to consider. So whether that be the expenses associated with the transportation every day, school uniforms, textbooks, etc., as well as the extracurricular activities. So it may be a case that the annual ski trip that your child goes on, these additional expenses could add up quite significantly year on year as well. So again, don't underestimate the true costs of the education. So now moving on to look at tertiary education, so more university focused. This data is actually based on university admissions in the UK. So as we can see here, the general trend is that the number of university admissions is actually increasing year on year, but more significantly as well, the number of international students as well. So that's also rising year on year. Now, if we move on to the next slide, I won't dwell on this too much. And now looking where this is actually most prominent, this trend. So as you can see from this chart here, the US, UK, and Australia seem to be the most popular destinations based on their intake for international students. And the general upward trend is happening in the UK and US, whilst the UK and Australia, whilst the USA is actually falling out of favour in more recent years. So I guess we can ask the question, why is this trend happening, and what are the benefits of studying overseas? So I can actually speak from my own experience. I was fortunate enough to have completed my university education in the Netherlands and Singapore. So this actually enabled me to actually kickstart my career here in Singapore, and of course I've stayed ever since. I was also able to develop a social network covering all corners of the globe. It got me out of my comfort zone, and there's also plenty of opportunities to travel, whether that's across Asia when I was in the Netherlands, or across Europe when I was in the Netherlands, or across Asia when I was based out here in Singapore. So all in all, quite a broad spectrum of benefits supporting the idea of an overseas education. But again, it's worth noting that this does come with the additional costs. So returning back to the survey, which we referenced earlier, 41% of parents in that survey would actually consider sending a child to university overseas. I actually think this statistic will probably be quite much higher in Singapore. Also, only 34% of parents are actually aware of the costs associated with an overseas university education. So obviously, in turn, these costs are likely to be underestimated and potentially unachievable as well. So reiterating the point of starting early and planning early as well. So now let's hone in on a couple of examples. So earlier we saw that the UK and Australia are becoming two of the more popular destinations for an overseas education. The fees themselves can actually be broken down into two segments. So obviously you have the tuition fees as well as the cost of living associated in each location. Here we're actually using the averages in each of those locations. So as you can see, the UK, the average tuition fee is around 22,600 per year, and that's all in Singapore dollars. And then the average cost of living is around, again, 22,600 roughly. So therefore, per year, you're looking at 45,200 per year to send your child to university in the UK. On the flip side, looking down under, when you're looking at university in Australia, the tuition fees are actually quite significantly higher. So they come in on average at 31,400 per year, but the actual cost of living is slightly lower at around 18,000. So here the average cost, well, the total cost per year is around 49,000 in Australia. So quite again, some significant figures. So returning back to the survey and learning from those parents who have been through or are going through the experience of funding their child's education, 49% of those surveyed actually stated they wish they saved earlier. 48% wish they, worry they don't have the financial resources to support their child's education, and 44% wish they had saved more regularly. So I think these stats really highlight the importance of planning ahead, obviously being disciplined and sticking to your plan. And of course, this will go hand in hand with providing more certainty and comfort in later years, obviously supporting your child through their education and university. So now I thought it would be useful just to break down a base case scenario. So this is very much a base case, and every individual has their own unique circumstances, whether that's the location of their education or the number of years that they're going to be educating as well. So if you'd like a personalized breakdown, then of course do reach out to us and we can provide a one-on-one breakdown for you or a forecast. So in this particular base case, so to set the scene, we have a newborn child today in Singapore. They attend international schooling in Singapore from ages 6 to 18, and then they move on to university in the UK, and we factored a 3-year undergraduate degree for that. So based on the averages that we've used throughout this presentation, so for the tuition fees and living costs, and we factored in the historical inflation associated with education. The actual total cost of the education fund required here is in excess of $1 million. So of course, quite a jaw-dropping figure, and particularly if you have more than one child. So this is of course based on an individual child. Also worth noting that this is based on the Singapore average for international school fees. So the earlier mentioned schools that I pulled up were obviously Tanglin, Dulwich and UWC. Their fees are of course on a significantly higher end. So again, this figure would be of course a higher total cost. So moving on, that's quite a startling figure in excess of 1 million. So let's just break that down in terms of what you need to do and obviously provide a bit more comfort in terms of how you're going to achieve that education fund. So after running the projections, if you started investing today, you'd have to set aside around $2,800 per month. If you were to decide to delay your planning and wait to start investing 5 years later, the investment amount would be quite significantly higher. So that would look at around $4,500. And then on the flip side, if you weren't to invest at all and just simply fund from cash as you go, you're looking at an outlay of on average $6,000 per month. So it's worth noting here, of course, the power of growth and compounding. So as you can see on the right hand side, the actual capital required from a monthly investment starting today totals around 748,000, whereas if you're going to fund it from cash, that would be obviously in excess of $1 million. So here that differential is around 330,000, and that 330,000 could in effect be used for other financial goals, whether that's your own retirement or even purchasing a property. So of course, again, reiterates the whole idea of planning early, investing early, and it will obviously lessen the burden in the latter years of your own planning. And that, I believe, concludes my section. So if I could open up the floor again to Matthew and Jasmine, if you could turn on your cameras once again. There we go. And Matthew, perfect. So this will be very much an open Q&A. We've had a couple more questions throughout. So going back to Matthew, if we can start with you. There's a question regarding insuring your child. So is it relevant to insure your child, and how common is it in Singapore?
I would say in the expat market I work in, it's not that common for people to take insurance for children. In the local market, it's very, very common for people to do it. My personal opinion is I don't understand why people don't take out the insurance for the child. So you can essentially insure your child from the point of when they're born up to age 65, 68, 70, whatever retirement age you want to pick. The premium, as I gave you examples of a 30-year-old taking 35 years worth of cover, or a 35-year-old taking 30 years worth of cover, it's going to be cheapest, and it's only going to get more expensive as the child gets older. And then you've got the ability to assign the ownership over to the child. So a mother or father can take out the policy with the child as the life assured. And then at such a time that that child attains an age of, whether that be 18, 21, when they become financially independent, you can then assign the ownership over to them and they can become the policy owner and just continue their own premiums. So there's no reason not to do it. I think some people do say to me, why take out cover on a child? For starters, life cover. If something happens to your child, no amount of money can compensate you for that. And I completely agree with that. However, if you look at it from the angle of things do happen, unfortunately, people do lose children due to diseases, due to accidents, due to any number of things. And it would give the parents an opportunity to grieve properly without needing to continue normal life to pay for their other children or jobs and that sort of thing. And I would say from the critical illness point of view, unfortunately, children do get sick. You know, there's always stories of children that get leukemia and things like that. Obviously, parents would have to fund the cost. So I do know of one person that worked in oil and gas a few years ago, had a very, very good job, was very well paid, a British guy. His child did get leukemia and he had to relocate back to the UK because even on his wages, he simply couldn't afford the cost of the child being treated in Singapore.
Sure. Thanks for that, Matt.
Yeah.
Just one more question. I think we can pose it to both yourself and Jasmine. I'm obviously conscious of time here. So from an estate planning perspective, is there anything I can do to mitigate UK inheritance tax, and would a payout on my death be also subject to inheritance tax for my beneficiaries? So perhaps open up to Jasmine first, and then if you want to add anything, Matt, please do.
Sure.
Yep. Okay, yeah. So I mean, usually when we talk about inheritance tax, the key idea is to kind of gift parts of your estate away. So you can, either directly gift, say, £50,000 to your children right now. But if you don't wish to do that, and obviously if you have minor children, then we would encourage the use of trust. So the use of trusts are very common in terms of kind of mitigating inheritance tax and your liability. And it's just kind of the best of both worlds. So first of all, obviously it mitigates your inheritance tax liability. You put a sum of money into the trust, but then also it does set aside, it allows you to set aside a sum of money for your beneficiaries, but also not allowing them to have access to the monies until you decide when, really. So yeah, that's kind of just how it's kind of like a brief overview of how you can estate plan and set up the use the trust to mitigate inheritance tax.
Yeah, I would just add on to that Aviva do have a trust. We do have a working UK trust that's available to UK nationals or spouses of UK nationals, and that's free to use. So if somebody taking out a policy with Aviva could take advantage of that.
Brilliant. Thank you very much. So I'm conscious of time. There's a couple more questions coming in, but we could perhaps address those directly with yourselves. So just wrapping up today's webinar, just some final points. So I guess in summary of today's session, I thought we'd just leave you with this 5-step plan. So after discussing the importance of estates protection and the education fee planning, it might be worth reviewing your own personal circumstances through this 5-step action plan. So firstly, if you haven't already, it's important to start planning your child's education fees. Review any existing insurance coverage and make sure it's fit for purpose. Plan for any unexpected and make arrangements for plan for anything unexpected and make arrangements for your will and your deed and guardianship, and then finally put the relevant structures in place to safeguard and pass on your wealth in a tax efficient manner. One more closing poll, just so we have a bit more of an idea if there's anything you'll be interested to learn more about. So which of the following areas would you need guidance on? We can obviously take a one-on-one discussion after the webinar. So spend a few seconds here. Brilliant. Brilliant. So for those that aren't familiar with the Heritage Partnership or St James's Place, I just thought I'd give a very high-level overview. So the Heritage Partnership is actually a partner practice of St James's Place. We specialise in bespoke, goals-based financial advisory for affluent and high net worth individuals. As one of the largest St James's Place practices in Asia, we actually have 4 commitments or 4 pillars to our approach. So it's very much being personal in our approach, taking very proactive steps, having strong morals, and then being principled. We of course seek prosperity for you and our community. Now just a brief overview of St James's Place. So we're actually a UK listed FTSE 100 company. So of course have offices in here in Singapore, Hong Kong and China, as well as our base out in the UK. Currently we work with over 760,000 clients globally, and they trust us in managing in excess of $235 billion. And we also have a strong belief of giving back to society, which comes back to one of our 4 pillars at the Heritage Partnership, and that's through our charitable foundation. So just moving on to one of our initiatives right now. So the Heritage Partnership, we're actually working through a fundraising initiative right now. So this is through March and April. Myself and the team are currently taking part in either a 240-kilometer run or 980 kilometers of cycling, and this is to raise funds for the charitable foundation. Currently, I personally am 630 kilometers in to 980 kilometers, so still quite some way to go. But if you'd like to learn more or even donate, please do. All of it is really appreciated, and you can actually scan that QR code on the right-hand side of the screen, and that will take you to the relevant page to learn more. So just some closing remarks. First of all, thank you very much to our speakers, Jasmine and Matt, for joining us today. And also thank you to all those that attended. All attendees will actually receive an email with a recording of this webinar. So if you want to rewatch anything, you can. And also there'll be a short evaluation form for you to fill out. So any feedback would be appreciated. And of course, leave any comments if you'd like us to follow up for a one-to-one consultation. So thank you very much, everybody. That concludes our webinar today. And thanks again, Jasmine and Matt, for joining us.
Pleasure. Thank you.